Well, joining us now, we've got Michelle Schneider, who is the MarketGauge.com chief strategist. Great to have you here with us this morning, Michelle. Perhaps we start off with that very question. How long can this sustain itself?
Well, what's so interesting is that we started out this year looking at a very key moving average, which was a 23-month moving average. And really why we looked at that is that it measured a 2-year business cycle within the typical longer business cycle, right, between 6 to 8 years. And pretty much everything in NASDAQ and certainly the big AI stocks have cleared that, showing some level of expansion, starting actually with the semiconductor sector. But what has not been able to clear has been the small caps. And so we came in thinking if IWM, if we're going to use small caps measure through there, or you can look at S&P 600 as well, cannot show any level of expansion while everything else continues to rock and roll at some point, and we've seen this historically, the large tech looks around and says, wait a minute, nothing is catching up. And that's when you start to see selling coming in. And that's when you start to see some level of equanimity between what's happened in the large caps and what's happened in the small caps, which right now is just so divergent. It's like a rubber band. It doesn't feel sustainable.
So, Michelle, is the AI trade saturated now or not yet?
I would say at this point, well, we'll take our own portfolio as an example. We have been in, not because we were such great geniuses from a thought standpoint, but from a pure math standpoint, if you just follow the technicals, we've been in the AI space all year and very heavy in tech. So we've taken profits along the way. So the question is, would you get in here? And I think in current environment, considering what we're seeing over the last couple of days, small caps couldn't get through and now they're starting to weaken. The consumer area looked like it was going to try to get bigger in terms of the discretionary space. That's contracting. The Fed obviously looking like they're going to raise interest rates again. I would say probably not the best time to get in.
Okay, and so with that considered, where else would you be placing your attention right now?
Well, I think this correction that we've had in particularly the agricultural commodities and even some of the soft commodities like sugar are now giving an opportunity to get involved with that space because the weather has not necessarily gotten any more cooperative in terms of drought and El Nino and then floods, and which often happens after long periods of drought. So we're looking there. We're looking at some of the basic materials. There has been a lot of talk, obviously, about increasing the solar space. Another announcement today by Biden that M-Phase was something that was going to get a $60 million infusion of cash. So I think anything that has to do with the EV space, not necessarily the EV space itself, but anything that supports the EV space. So we've been looking at some of the basic industrial metals again that got really beat up. Defense, I think, is always a good idea. And biotech, which has been really doing nothing for the entire year, could actually start to do a little bit better. We're looking there as well. Some of the ones, again, that have been beaten up in the IBB or the XBI space.
All right, Michelle, so, okay, we're broadening out this conversation. So the adage used to be sell in May and go away. That didn't happen. You say sell in July. Should it be sell in July and fly?
Good one, Diane. I'm going to use that.
Go right ahead.
Well, July is a very interesting month because the year is half over, right? So what we had in January, and then we do it again in July, is a 6-month calendar range. And of course, nothing is 100% when you're looking at this sort of statistics. But in January, it worked amazing, right? As soon as we hit January, NASDAQ in particular reached above a 6-month calendar range high, which means that the first 10 trading days in January develops a range. And if you get above that range, you have a good edge in terms of it having follow through. And that happened. Whereas in the small caps, it happened briefly and it hasn't been above that 6-month calendar range high since. We reset now in 10 trading days, which will be about July 18th. Once again, if these small caps continue to fall under pressure and break down under the July lows once we get to that point. And NASDAQ cannot clear that 6-month high again like it did in January. I would say that there's a good chance that, yeah, sell in July as we get into some really strong headwinds after all the optimism we had the first 6 months.
And we know that there's typically lower volume during the summer months as well. But even in that lower volume, are you anticipating that we'll see some slippage over the course of the rest of this summer, or just kind of some choppiness that is perhaps netting out neutral by the end of it, which for a lot of the banks that are still bearish for their outlooks for the S&P 500 by the end of the year, it seems like more of them are expecting that slippage to perhaps take place. And if that does take place and ensue during Q3, what does that even spell out for Q4?
Well, yeah, I mean, I don't think I remember seeing such different calls for what's going to happen in the market over the next 6 months. Some people think that we're going to new highs. And they're using all types of reasons why. Obviously, housing market is stronger and the jobs market is stronger. And from a technical standpoint, really basically what happens Thursday and Friday, we have not had 2 down days in a row since May on a Thursday and Friday. So people are looking at all these reasons to be extremely rosy. And then, of course, you have the banks that are looking mainly at this yield curve inversion, which has led to a recession almost every time, even if it doesn't happen exactly in the timing that everybody thought. So yeah, I would say that we're definitely looking at, if we're looking at it as a trading range, and particularly going back, maybe even use S&P, forget about small caps. If 4,400 to 4,500 turned out to be the top of the trading range, which is completely in line with the small caps going to 1,900 and not getting through, then it makes sense that we could see a move down even closer to 1,700 in the small caps again, which of course would bring the S&P back down at least to 4,000 and maybe back down to 3,800.
Michelle, you say a lot of people are looking for everything to remain rosy. Are you expecting something different for this back half of the year?
Well, again, the first 6 months, there was nothing but reasons to be cheerful. So, right, we had, first of all, the Fed certainly slowed down the rate of change in terms of how much they were going to raise the interest rates. And people were anticipating some kind of pause or pivot. And they themselves have said that they were going to kind of cap it at 5 to 5.25% in terms of the Fed funds rate. So that gave the market optimism. The economic situation was that it seemed like it contracted enough. The consumer was strong and continued to buy, whether it's because of YOLO or whether they thought that inflation had peaked. And that was the other thing, is people thought inflation had peaked. And all these reasons, and especially the AI explosion, gave the market optimism for 6 months. Markets forward thinking. So now you have to wonder, where's going to be the optimism for the next 6 months? I'm not necessarily seeing it because there are so many areas that could be cause for concern, including geopolitical situation, social unrest situation, obviously rising yields, and inflation based on Mother Nature that's not so easy to control. So the consumer is stretched, and we'll see if they can continue to stay in the game. If they can, that's a good reason to be cheerful. If they can't, not so much.
Michelle, stay with us. You mentioned geopolitical, and we want to continue to kind of look at the international situation as of right now. China's economic recovery is stalling. The country's benchmark Shanghai Composite Index, it's on track to shed most of its gains since the year began, as weak data continues to weigh on confidence in the nation's recovery. Look at what's ahead for the world's second largest economy and what a faltering recovery could mean for other markets across the globe. We're joined now by Michelle Schneider, MarketGauge.com chief strategist. So, Michelle, first, let's start there, because there's the recovery that China is in control of, and then there's the recovery as well that will be perhaps a byproduct of more partnership internationally or globalization efforts in the face of deglobalization that's already taken place.
Right. It's so complicated when you talk about China, because obviously there's always the question on whether or not we're getting the statistics in the most accurate and timely fashion. But there's a couple of things that we do know about China. Number one is they have a very long range view, right? They're not necessarily like we are here in the U.S. They're not necessarily looking at month to month dot plots like the Fed does here and if this, then that. They have a long-term view that they've already put into place. One, of course, was to basically eradicate poverty, which they have almost successfully done. And in the course of that, they built a lot of housing, some of which hasn't gotten filled yet. And so that's been one of the things that have put pressure on China. Another thing that has put pressure on China, of course, has been that there was a huge amount of restriction in their own technology sector that was put on by President Xi. And that caused a tremendous drop in companies like Alibaba and Baidu. And I think that's been rolled back. And of course, now what's happening here with the U.S., and of course, Janet Yellen is on her way there, if not there already, has not helped as other countries are starting to look elsewhere for some manufacturing. And of course, the other thing, China was really, really late in terms of coming fully back, if they're even fully back, from COVID. So you put all these things together, we've got a blip right now. Longer term, though, as you mentioned, Brad, China is trying to make deals. They've been working with Russia. They've been working with India. There has been talk through BRICS about the yuan being more international in terms of a currency to be used. And so I don't necessarily think that right today would be the time to invest in China, but I would certainly not think that from a long-term standpoint, it isn't setting itself up for some very low-risk opportunity.
Michelle, I want to ask you, you mentioned obviously Yellen being in Beijing. How do we view that? Is that good for the U.S.?
Well, it can't be bad, right? It certainly can't be worse than what we've had going on so far. And like Blinken was there, and I don't really know if there was anything great that came out of that particular meeting that they had. And now Yellen is going to be there really more specifically to try to boost cooperation between the two countries. And so I'm hoping that there's some level of success there. Of course, again, right, Diane? So complicated because if we start to rely more again on China for our exports in terms of them taking stuff from us and us taking stuff from them, and the trade deficit gets shifted a little bit, that could be actually more of a problem. But let's hope that that she could go there and at least make some inroads.
I want to pivot a little bit, Michelle. Well, you talked a little earlier about weather, extreme weather, really a growing concern as we enter the second half of the year. Now, this week saw the highest average global temperature on record. I know we felt it here. So what do you expect to be, and are we underestimating the economic, financial impact of growing issues with regard to extreme weather and climate change?
I absolutely think that we are underestimating it. And it's unfortunate that there is a political ramification with this whole conversation, which I will try to steer clear of and just say from a factual standpoint. There has been drought, obviously tremendous drought. There's been tremendous swing in the weather, as you mentioned, the record high in terms of heat. I mean, and people have to understand, record high means as far as they have actually measured heat. So it really goes way back. And, you know, could you argue that this is going to be temporary and it will resolve itself in 2, 3, 4 years? Maybe. We don't know. But what we do know is that there is a correlation between emissions from oil and gas and weather. We do know that the sea levels are rising in certain areas, which is why you've had these incredibly tremendous floods and typhoons and hurricanes, and we're heading into hurricane season. So yeah, if you just look at all of this, you have to say we're already seeing an economic impact. Look at the fires in Canada and what kind of impact that's having. And lumber prices, which were falling, started going back up. And that's the kind of thing is you have to look at the ripple or the domino effect of this and say, at what point do companies, certain companies that have the pricing power to be able to withstand that, while other companies won't be able to, they'll have to raise their prices. And of course, that will impact the consumer. It's always back down to the consumer.
Where will this begin to show up, do you believe, most immediate, Michelle? Because we're already thinking about, and I'm actually thinking about some of the work that our social media team did in looking at some data that was from the Insurance Information Institute, I believe, just at premiums of insurance. And over time in a state like Florida, how that's risen, especially given the fact that you've got more severe weather events.
Well, when you say where do I think that will show up, you mean in terms of which commodities might be impacted, or
where for the consumer, whether that's insurance, whether that's, how you are thinking about even making sure that the home that you're building is more resistant to some of these events too.
Well, right. I mean, just having fire and flood insurance. I mean, we live in New Mexico, so fire insurance is something that you absolutely have to have here. And that was not necessarily a big concern in the East Coast or Canada. Now, of course, that is. Flood insurance in Florida has been a must, and that also has increased to some of the other areas. So that's going to be, but, I look at really what happens to food prices and even oil and gas prices. While we're starting to do more mass adoption into EV space, the truth of the matter is most cars are still oil and gas fueled. Homes are still oil and gas fueled. So I think that's really where you're going to have to look to see the impact of consumer. And even though gas prices have come down, the oil prices actually, in the face of all of the high interest rates and everything else we've talked about, are starting to creep back up. And if we start to see oil getting past $72 a barrel and then past $75, $76 a barrel, I think that that trickle effect will be huge for consumers, definitely. And that will just add a lot of stress all around.
Michelle, learned something new about you every time we talk. Didn't know you were in New Mexico, the state that houses both Albuquerque and Truth or Consequences, New Mexico as well. Thanks so much. Michelle, stay with us. We've got much more markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
A new earnings season just around the corner. And as usual, big banks like JP Chase, Wells Fargo, and Citigroup will kick off the busy quarter next week. But Wall Street's biggest banks might be facing tighter profit margins following the aftermath of the banking crisis and collapse of Silicon Valley Bank back in March. Now, some analysts are painting a gloomy picture for this quarter, saying Q2 is expected to be the third consecutive quarter of declining S&P 500 earnings. Michelle Schneider, MarketGauge.com chief strategist, is still here with us. So, Michelle, do you agree with that assessment?
Well, if we look at what had boosted the bank earnings in the past, a lot of it was from their financial side, right? From people being involved in investments and that liquidity that it added to banks. And also being able to borrow money, which right now is much more difficult at these higher interest rates. And even though the housing market has been strong, obviously mortgage applications have been impacted by rising rates. So yeah, at this point, I would think that for this quarter, we will not necessarily see very strong bank earnings. And you mentioned the banking crisis. Some people feel that it was just a little bit too soon in terms of saying crisis over. I mean, what did it last? Like about 4 days. And so the higher the interest rates go, that could put a lot of squeeze, particularly on the commercial real estate and the regional bank side. So I would not have great high expectations at this point.
Do you think there's a theme that emerges this earnings season? It seemed like last earnings season, it was all about how can we say AI in a various amount of ways for companies who had no business saying it, some of them. So, Michelle, is there one theme that you believe will emerge this earnings season?
Well, again, I think that you have the advantage is going to be to any of these companies that have managed to survive throughout the first 6 months because of their operating cash flow, and that has given them some level of growth. And, that's why you have to mention AI, right? Because that certainly has happened there. So that's kind of what I would continue to look at. I mean, just take Nike in terms of the consumer space, right? Earnings not great, and Nike stock has been falling. So if that's any kind of foreshadowing, that means that we will see a lot of stress in terms of the earnings. And it's going to be, of course, what they say about future as we get through the rest of the year. And at this point right now, with expectations of 2 more interest rate hikes, and as we talked about already, inflation not necessarily being controlled, at least in the places that affect consumers the worst, Yeah, I would think that we'll see AI probably still do well, Apple, all these companies as they continue to compete with one another, but a lot of the other companies not necessarily doing so great.
So can you name more of those companies besides Nike that where you expect to see some stress? Would these be consumer-facing companies, or where are you expecting to see the stress?
Well, we started with banks, so I think the banks can set the tone for sure. And if they do not come in great or worse than expected, right? I mean, the thing with earnings seasons, first of all, is that it's always looking backwards. And it's really about what the actual number is versus the expectation that has the greatest impact to the market. And even that is sometimes a short-term impact. So the longer-term impact generally is what they project going forward, the guidance. And so, yeah, like, let's take some of the high flyers in terms of the consumer space that we've seen in the past, Lululemon being one. I think that those kind of companies could actually start to feel the strain, whereas some of the fast food companies that had stress could actually start to come back a little bit, like a McDonald's, for example. So I think that that's really, you have to think what's going to be, if everything we've just talked about, Diane, turns out to be true, if the market has seen a top, if the yields are going to have to be stretched, if we are going to enter more stagflation, potentially recession as we get into 2024, where are these companies, where are people going to spend their money? And they're going to spend the money on more of the staples, which did terribly, right? I mean, Target, of course, it had its own reasons for doing bad outside of being staples, which went down against discretionary, but that could rebound. A company like Walmart could continue to do well, where people are going to go and buy cheapest goods they can get at this point.
Michelle, just lastly, while we're on this topic, one of my favorite conversations to kick off the earnings seasons is with Delta's executives because it gives us a sense of where this countercyclical recovery that we've heard about from travel companies is continuing, or what type of consumer profile they're continuing to engage with, particularly across services spending right now in the experience economy. Are you expecting for there to be any slowdown within that?
Well, it's such a good question, Brad, because we actually were in the cruise line stocks and have taken some profits along the way. And I've talked to people who do go on a lot of cruises that said they're booked out for at least the next year. And so, again, at this point, that still could be an outperforming area as people seem to be cutting back in certain things, but yet wanting to get out, wanting to get away, wanting to go on a cruise, wanting to get on a plane. Do I think that that can be impacted? Of course. As we know, when things get sour, if they go sour, it's really hard for anything, particularly in this more sort of discretionary area, to sustain. And then we have this other kind of crazy thing going on, which is the possibility of labor unrest as wages continue to have to increase to keep up. And, you had a strike right now in UPS, and I think it's still out there. And there's been threats of airline strikes. So I think I wouldn't necessarily be all that overly optimistic anywhere when it comes to the equity space, even in the airlines and the cruise lines.
Interesting. So maybe some caution ahead. All right. Michelle Schneider, thank you so much. We appreciate you for joining us today. Michelle Schneider, MarketGauge.com Chief Strategist.